Assalamu alaikum, dear student. This is Sir Abil Ahmed, your SBR teacher. We are starting our second lecture on SBR. I strongly believe that you have seen lecture 1 and now you're watching lecture 2. At the end of lecture 1, I did discuss the entire conceptual framework. Basically, when we talk about IS 16 measurement models, IS 16 gives us two choices. It gives us two accounting models. One is cost model, another is revaluation model, which I'm going to discuss just right now. Conceptual framework, this one we did discuss in the previous class. Simply, the main idea which is written in this conceptual framework is actually conceptual framework is also consistent with IAS 16. Conceptual framework also gives you the historical cost and current values. And it gives you an example. For example, let's say if you have a property, plant and equipment and which is used in the manufacturing process. Obviously, the plant which you are using in manufacturing the product, you are not going to sell that plant obviously. Definitely you will be using the entire life of that plant, and at the end of the useful life you will be selling it. What I really want to say, the plant which is being used in the production, the plant through which we are producing different products, so we don't care what is the market value of those plant in the market right now, because that's not relevant for us. Why? Because we are not selling that particular plant. In addition to that, normally the changes in the market factors, they don't affect the value of such plants. But if we talk about land and building, if we talk about land and building, obviously the changes in the economic factors, they really change the value. They do bring a really big change in the value of land and building. So we can say that then those property, plant and equipment which we are using in manufacturing, which we are using in manufacturing, you should be using, you should be keeping those plants at historical cost, no issue at all. But land and building, you should be keeping at current values, at fair values. So but these are just an example. Obviously, it's pure judgmental. Either you go for cost model, or let's say either you keep your asset at historical cost or current value. The main point is the preparer of financial statements, they have to make a proper judgment. They need to make sure that they should keep their property, plant and equipment either at historical cost or current value, which they believe is going to be relevant for the user of financial statements. For example, as I give you the example, the land and building, if the economic factors they changes, they do bring a really big change in the value of land and building. So it makes more sense to keep land and building at fair value rather than keeping them at historical cost. But it is written here, such decisions are judgmental. Preparers of must ensure that qualitative characteristics of useful information are maximized as far as possible. Now let us discuss. IAS 16 actually gives us two models. IAS 16 gives you the choice either to go for cost model or go for evaluation model. A very important point, whenever the word comes choice, it means we are talking about accounting policy. Actually, accounting policy gives you the choice. So it is a choice of a company either to follow cost model or revaluation model. It's up to you. Under the cost model, property, plant and equipment is held at cost, and you need to deduct accumulated depreciation as well as if there is any impairment loss, you need to deduct that as well. So simply under cost model, property, plant and equipment, you have to take cost, you need to deduct all the accumulated depreciation, you need to deduct impairment loss as well if you have. So you'll be getting the carrying amount of property, plant and equipment. If you say no, instead of revaluation model, our organization should, instead of cost model, organization should go for revaluation model. Okay, you can do that. In case of revaluation model, your property, plant and equipment is carried at fair value. You need to deduct less any subsequent accumulated depreciation and impairment loss. So you will be keeping your property, plant and equipment at fair value, and then whatever the subsequent depreciation comes after the fair value, you need to deduct that as well as impairment loss. If the revaluation model is adopted, then IAS 16 provides the following rules. Now, what are the rules? Let me explain. For example, we have a property, plant and equipment. Let's say the carrying amount is 100. Let's say the useful life is just 5 years. Okay. And the same property, plant and equipment on the same date is having a revalued amount. Let's say 120. That is case A. The property, plant and equipment which is having a carrying amount 100 million. Let's say it is having a remaining useful life of 5 years. Okay. On the same date, it is having a revalued amount of 120 million. If the company decides to go for a revaluation model, what do we need to do? We have to bring this 100 to from we need to bring this property, plant and equipment from 100 to become 120. So we need to recognize a revaluation surplus of 20 million. Simply, if I talk about the double entry, I have to debit property, plant and equipment with 20 million. Revaluation surplus slash OCI, other comprehensive income, is going to be credited. So simply you need to debit the property, plant and equipment and credit revaluation surplus slash OCI. Because the current year revaluation, you need to show that current year revaluation in other comprehensive income as well. Okay, this is case A. Now let me show you the case B. It is also possible. The carrying amount is, let's say, 100 million on the same date. Let's say case B. Examiner says on the same date revalued amount is, let's assume, 90 million. Repeat, the carrying amount of property, plant and equipment is 100, revalued amount is 90, and we are revaluing this asset first time. So in case B, you can see that when I'm going to revalue the asset, the revalued amount is 90 million and the carrying amount is 100. So we have to basically bring our 100 million property, plant and equipment from 100 to 90 million. So logically, we have to recognize a loss of 10 million. Since it is the first time we are revaluing the asset, it is first time and value is not increasing, it is actually decreasing. So if you are revaluing the asset and it is the first time of the asset being revalued and value, instead of increasing, it is decreased, then you have to recognize the loss, and that loss directly goes to profit and loss. Logically, it is impairment loss. So when I am revaluing the asset first time and value, instead of increasing, it is decreasing. So look at this. In case B, what entry I have to make? I'm going to recognize the impairment loss because I don't have any revaluation. It is the first time. Impairment loss, simply SOCI, profit and loss, debit by 10, and simply you need to credit the property, plant and equipment by 10 million. This is case B. Now let me explain the case C as well. Case C. Let me come here. Case C. Assuming we have a property, plant and equipment. The carrying amount is 100, which is 100 million. Includes revaluation surplus of 5 million as well. Repeat. The property, plant and equipment which has a carrying amount of 100 million, it includes the revaluation surplus 5 million as well. This 100 is having the impact of 5 million revaluation surplus as well. Okay. On the same date, examiner says now revalued amount is, let's say, 85 million. The useful life is given. The remaining useful life is 5 years. A very important point, you have been given a 100 million carrying amount and examiner says this carrying amount is having the effect of revaluation surplus 5 million as well. And now examiner is saying the revalued amount is 85. So when I'm going to bring this 100 to become 85, when I'm going to bring this property, plant and equipment to 85, we have to recognize a loss of 15 million. But when I'm going to recognize a loss of 15 million, before recognizing this impairment, there's loss of 15 million, I need to see. We need to first eliminate the revaluation surplus which is in the carrying amount of this 100 million, which is included in this 100 million. So how do we recognize the loss of 15 million? You have to bring your 100 million asset to become 85. You need to recognize a loss of 15 million, but this time the entire loss will not go to associate, the entire loss will not go to profit or loss, because you also have a revaluation surplus in the carrying amount. So what to do? Look at the double entry. Debit and then I have a credit. First, you need to eliminate the revaluation surplus. Revaluation, OCI debit with 5. Over and above is your impairment loss. That goes to associate income statement 10 million and property, plant and equipment 15. Look at this. In case A, we've revalued the asset first time from 100 we have come to 120, so we made this entry. Case B, first time we revalued the asset, but from 100 we came to 90. So instead of increase in the value, there's a decrease. So it was, since first time there wasn't any revaluation surplus already in the carrying amount. So in part B, what we did, impairment loss, associate debit, property, plant and equipment credit. But in case C, examiner says, assuming this 100 million includes the revaluation surplus of 5 million as well. And let's say, now examiner says the revalued amount of this property, plant and equipment is 85. So we need to recognize the impairment loss of 15 million. How do we recognize the impairment loss of 15 million? First, you have to eliminate the revaluation surplus which is already in the carrying amount of this property, plant and equipment. Loss which is over and above this revaluation surplus, that is your impairment loss, that goes to associate income statement, you can say profit or loss. So these are the three cases. Now let's see here. Another point for the revaluation model is, actually, when do we need to carry out the revaluation? When do we need to revalue the asset? Do we need to revalue the asset every 1 year, every 2 year, every 3 years? A very important point. What should be the frequency of revaluing the asset? IAS 16 does not give us any frequency of revaluing the asset. Simply IAS 16 gives us the guideline that if you are following a revaluation model, all you need is just make sure that the carrying amount which comes in your books should not be materially different from the fair value of the asset. So when the IAS says if you are following the revaluation model, all you need is just to make sure that the carrying amount which comes in your books should not be materially different from the fair value of that asset. It does mean that we are not actually revaluing every year. So simply IAS does not give us exact guidelines when do we need to revalue the asset. Simply every year revaluation is not necessary. If company wants to revalue their asset every year, they can do that. If company wants to revalue their asset every 3 years, it is also acceptable. If company wants to revalue their asset after every 5 years, it is also acceptable. So simply, when do we actually need to revalue the asset? The frequency of revaluation is not given in IAS. Only the guideline is given as if your company believes that the value of your asset fluctuates a lot and every year you want to revalue, go ahead. If you want to revalue after every 3 years, after 5 years, that is also acceptable. So let's see what they say. IAS says now. Under the revaluation model, property, plant and equipment is carried at fair value less subsequent accumulated depreciation and impairment. If revaluation model is adopted, then IAS 16 provides the following rules. I try to discuss all these rules. Revaluation must be made with a sufficient regularity to ensure that carrying amount does not materially different from the fair value at each reporting date. Like you can revalue after every 1 year, after every 3 years, even after every 5 years. If an item is revalued, the entire class of assets to which item belongs must be revalued. Look at this. If you are revaluing the asset, then you have to revalue the entire class of that asset. What do you mean by this? Let me give you an example. If, for example, if father, let's talk about a father. Let's talk about a husband and wife, assuming they are having just, let's say 7 children only, okay? If the father gives gift to one child, obviously it's very unethical. Very unethical. You have to give gift to all of your 7 children because they all belong to you. So obviously, father is not going to do this. That he's not either. He will not be giving gift to even any one of them. If he decides to give gifts, so obviously he's going to give gift to all of his 7 children. So it's the same thing is here. If you are revaluing a, for example, let's say a land and building, and you have number of lands and buildings, so you can't do that. If all the buildings are carrying more or less the same work, you can't do this. That you have revalued building A and you are not revaluing building B. Why? It's not allowed because it says if an item is revalued, the entire class of assets to which the item belongs must be revalued. Okay, should keep the example of a father when he decides to give gifts. So obviously he has to give gift to all of his 7 children. Okay. If a revaluation increases the value of an asset, the increase is presented in other comprehensive income and disclose an item that will not be recycled to profit and loss in subsequent periods held under a revaluation surplus within other component of equity. What does it mean? Let me explain. Look at this first entry. We have debited property, plant and equipment. We have created revaluation surplus. We have shown this in other comprehensive income as well. When I'm going to prepare the SOFP, statement of financial position, in SOFP in equity section, instead of writing revaluation, instead of writing OCI, I'm going to write other OC, other component of equity. And in other component of equity, I'm going to write this 20 million. So simply, the revaluation comes 20 million. What is a double entry? Revaluation slash OCI credit. When I'm going to show the same thing in statement of financial position, you can do this. You can show that this 20 million revaluation surplus under other component of equity, 20 million. If you don't want to do that, you can still write revaluation surplus. It is equally acceptable, no problem at all. So it is up to you. Either you are writing this 20 million under OC, other component of equity, or you are using the terminology revaluation surplus in equity section of SOF. Okay. Another point it says that this will not be recycled to P&L. What does it mean? Now look at the case A. Okay, just look at this case A. If you are going to sell this asset after, let's say, 6 months, after 1 year, after 2 years, this 20 million revaluation surplus will not be recycled to P&L. All you need is, you can do one thing. This 20 million will be close to retained earning at the time of disposal. Simply this 20 million will not be recycled to P&L. And let me explain this point. For example, assuming we have a property, plant and equipment, the carrying amount is 120 million, including, let's assume, revaluation surplus 10 million. Just an example. Just an example. Property, plant and equipment, the carrying amount is 120 million, including revaluation surplus 10 million. Okay. Sold for, let's say we have sold this asset for 125 million. So what should be the double entry? Look at this. Debit, credit. I'm going to debit the bank with 125. The revaluation surplus, which is included in the carrying amount of this property, plant and equipment, you cannot recycle this 10 million to profit or loss. So what you have to do? Simply debit this revaluation, or another you can use the word OCE, other component of equity. You cannot write even OCI. So this revaluation surplus can be close to retained earning if you want to do that. So bank debit, revaluation slash OCE, other component of equity debit. Okay. Your property, plant and equipment is credit, which is 120 million. The gain on disposal is 5 million, which comes in P&L. The carrying amount is 120 million. The asset which has a carrying amount of 120 million, we are selling this asset for 125. The asset which has a carrying amount of 120 million, we are selling this for 125. So there is actually gain on disposal of 5 million. So that gain on disposal is recognized in P&L. Gain on disposal. Profit or loss or SOCI, statement of comprehensive income, 5 million. But this revaluation, 10 million, which we have debited, this can be close to retained earning. This cannot go to profit or loss. So the revaluation surplus, which is included in the carrying amount of the asset, if you're selling that asset, so that revaluation cannot be recycled to P&L. Only you can do one thing. If you want, you can close that revaluation to retained earnings. Okay. If a revaluation, it is written. If revaluation increases the value of an asset, the increase is presented as other comprehensive income and disclosed as an item that will not be recycled to profit and loss in subsequent periods and held in revaluation surplus with another component of equity. If a revaluation decreases, the value of asset decreases should be recognized immediately in profit and loss unless there is a revaluation reserve representing surplus on the same asset. Look at this. Case B. In case B, what is happening? We are having a property, plant and equipment with a carrying amount of 100. It is having a revalued amount 90 million. So immediately we recognize a loss of 10 million impairment loss, and already this 100 million does not have any revaluation surplus. So what we did, we just recognized the impairment loss of 10 million in P&L, profit and loss, SOCI. But look at this, in case C, what is happening? We are recognizing a loss of 15 million. Because from 100 we are coming to 85, but this time the 15 million loss is not going to P&L because this 100 is also having the effect of 5 million revaluation surplus. If there is an effect of revaluation surplus, first you have to eliminate that revaluation slash OCI debit. The loss which is over and above the revaluation surplus, that goes to P&L. This is actually your impairment loss which goes to P&L. So these things are written here. If a revaluation decreases, the value of the asset decreases should be recognized immediately in profit and loss. Profit and loss, another name is SOCI, unless there is a revaluation reserve. Obviously, if there is a revaluation reserve, first you have to eliminate that revaluation surplus and amount of the loss which is over and above the revaluation, that goes to P&L. Now let's talk about depreciation. Actually, what do we have in depreciation? Let me explain a few points relating to depreciation. Just a minute, Azan break. Okay, let me discuss. Let us have a discussion on depreciation. What is this depreciation? Let me explain. Don't worry, I'm going to share this document with you. You will get this PDF as well. Depreciation. Actually, depreciation is systematic allocation of depreciable cost over the useful life of tangible non-current asset. Now the question arises, there are two things. What do you mean by systematic allocation and what do you mean by depreciable cost? Very easy. Depreciable cost means simply cost minus the scrap value, residual value. Repeat. Depreciable cost means cost minus residual value. Okay. Now the question is, what do you mean by systematic allocation? Actually, try to understand this systematic allocation. Systematic allocation means, according to IAS 16, the pattern of economic benefit which you are getting, which you will be getting from your asset, the pattern of economic benefit from the asset should match the pattern of economic benefits and depreciation method should match. What do you mean by this? For example, if you are getting same economic benefit from the asset, then depreciation method should be straight line. But if you say no, my asset is new and initially it is going to give me more benefits and later on it is going to give me less benefits, then you should be going for reducing balance method. Because what happens in reducing balance method? In earlier years you will be having more depreciation and later years you will be having less depreciation. So systematic allocation means organization's depreciation method should be matching with the pattern of economic benefits. Let me give you the example again. If you will be getting more or less same benefit from the asset, same economic benefit every year from the asset, then you should be using a straight line method, obviously. Second, if company says no, the asset is new, it will give us more benefits in earlier years and less or reduced benefit in later years, then organization should be using reducing balance method. It means that IAS 16 does not give you a choice, whatever depreciation method you want, you can use. No, 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 you can't do that. You cannot say this. IAS 16 says your depreciation method should be matching with the pattern of economic benefits. So logically, you do not have a choice which depreciation method you want to follow. Because choosing the depreciation method is not an accounting policy. You do not have a choice. You have to make sure your depreciation method should match with the pattern of economic benefits which you are getting from the asset. For example, if I talk about a building, so normally you can say from building we get more or less the same benefits, go for a straight line. If you have a new vehicles, so normally in cars, in new vehicles, what happens? You will be getting more economic benefits in earlier years and less reduced benefit in later years. So I believe reducing balance method is well suited. Now a very important point. This is I explain the systematic allocation. Now listen carefully. According to IAS 16, your organization will have to make sure if the pattern of economic benefit changes, then you need to change the depreciation method. So it is very much possible. Earlier you were at a reducing balance method because initially you were getting more benefit from the assets and then reduced benefit, but now you think that we will be getting more or less the same benefit every year. Then you will be coming from reducing balance method to straight line method, and it will be treated as change in estimate. And whenever estimate changes, it is applied prospectively. Prospectively means in the present and future. Whatever you have done in the past, that will not be reversed. So change in depreciation method is treated as change in estimate, which is applied prospectively. Prospective means present and future. Whatever you have done in the past, we will not reverse that. What do you mean by this? For example, let's say you bought, let's say APLC bought property, plant and equipment for 80 million. 80 million, let's say on 1/1/2000, let's say 20. It has a residual value, let's say 16 million. Company is using reducing balance method, 27.5%. Now question says on December 2021. Let's say in December 2021, company has realized that depreciation method should be now straight line, because let's say the pattern of economic benefits, they have changed. Okay, the useful life of the asset is 5 years. The useful life of the asset is, let's say, 5 years. This is the scenario. APLC bought property, plant and equipment for 80 million on 1/1/2020. Useful life is 5 years. Residual value is 16 million. Company is using reducing balance method 27.5% on December 2021. Company on this date, actually, let's say company has realized that depreciation method should be now straight line. Reason I'm repeating, due to lack of timing, I'm not writing it. The reason is, let's say company is saying the economic benefit from the pattern of economic benefit from the asset, it has changed now. So instead of reducing balance, we should be on a straight line. Now what to do? Number one, see, December 2020, you have already charged reducing balance method. So whatever you have charged in 2020, I'm not going to change that, because change in estimate is applied prospectively. Prospectively means, since you are deciding the change on in 2021, okay, even it's the last date, no issue at all. You are deciding the change in 2021. So what we have to do? We have to apply it this, because in 2021 company has realized that instead of reducing balance, we should be at straight line. So now what to do? Change in estimate is applied prospectively. Prospectively means 2020, in 2021 and in future years, you will be using a straight line method, because this is the year in which you have your pattern of economic benefits have changed and company has realized to change the depreciation method. So what to do? In 2021, first only we have to bring the changes in 2021. There will be no change in 2020, okay? Because change in estimate is applied prospectively. Prospectively means in the current year when the change has come, and future years. So in 2021, first you have to reverse the previous depreciation. Second, you have to recognize the new depreciation according to straight line method. So in 2021, there will be a reversal of depreciation. Now listen, in 2020, you bought this property, plant and equipment for 80 million, depreciation 27.5%, reducing balance method. So let me use the calculator. If I take 27.5% of 80 million, I'm getting 22. So it means in 2020, you have recognized the depreciation, you have charged depreciation expense 22 million in, just a minute. Okay, I'm sorry for that. In 2020, you have charged depreciation expense of 22 million, or in 2021, the depreciation which you have charged is 66, is the carrying amount of property, plant and equipment. Depreciation expense is 27.5%. If we take 27.5% of this, if I take 27.5% of this, I'm getting 18.15. So actually I have to reverse this depreciation, because in 2021 you have, let's say, charged depreciation expense according to reducing balance method, but in 2021 you have realized the pattern of the economic benefits have changed. So instead of reducing balance method, we should be at straight line. So it means that 2021 reversal of depreciation expense is 18.15. What will be the impact of this reversal? Let me explain. Logically, due to this reversal of depreciation expense, your property, plant and equipment will increase by 18.15 and your depreciation expense will be reduced by 18.15. This is what we have reversed the depreciation which we have recognized according to reducing balance method. Now in 2021, since the pattern of the economic benefits have changed, so we have to change the method, and now the company is saying a straight line. So what we have to do? Look at this. At the start of 2021, the carrying amount is 66. Scrap value is given, which is 16. Initially, the life was 5 years. Since the change is coming in 2021, so the life is only 4 years now. So what do you have to do? Now let us recognize the depreciation expense according to straight line method. How do we recognize the depreciation expense according to straight line method? We have to take 66 minus the scrap value, which is 16, divided by 4. Because now the remaining life is just 4 years. So the depreciation is coming 12.5. So now actually in 2021 we need to recognize the depreciation expense 12.5. So what to do? Simply the depreciation expense is 12.5. Your property, plant and equipment is 12.5. Obviously we know that if you debit the depreciation expense and credit provision for depreciation, then obviously that provision for depreciation is deducted from the carrying amount of the property, plant and equipment. You will get the same impact. So all you need is just explain your examiner that in the year in which the pattern of economic benefit has changed, so company will have to change the depreciation method. And since it is change in estimate, it is applied prospectively in the current year and in the future year. Look at this. I did not do any change in 2020. I did change the depreciation expense each and everything in 2021, the year in which depreciation method is changed. So I'm just stopping my lecture over here because it's a namaz time. So inshallah, lecture number 3, I will start from here. So thank you very much for watching this lecture. Have a nice life.